Thank you for joining today's webinar that we've titled Value Has Rebounded, Now What? I'm Brent Ledbetter, a partner at Research Affiliates focused on the distribution of our equity strategies. I have a few brief housekeeping notes I will cover quickly since I know you all joined to hear from Rob. First of all, I want to say thank you to everyone who already submitted questions. Also, a reminder that you can also submit questions during the webinar using the QA field on your screen. You'll see a list of resources on your screen, including a link to the slides Rob's going to reference, as well as links to the two interactive tools on our website, Asset Allocation Interactive and our Smart Beta Interactive tools. Every webinar comes with a survey, and ours is no different. I will note it's only 3 questions, and we very much welcome your feedback. So please take the time to complete the survey for us. If you have additional feedback, you can also email Rob or me directly via the links on our bios. So that's enough for me, and I'm very pleased to hand it over to our founder and chairman, Rob Arnott, who's going to talk about his market outlook in today's environment.
Thank you very much, Brent. What I'd like to do is firstly acknowledge all of the challenges we've all faced in the last 16 months and the remarkable market crash and remarkable subsequent rebound and the rebound in the economy that we've seen since then. This has been a tumultuous time and a tumultuous market. So let's dive in and look at some of the materials that we've prepared for this. Firstly, a small group of winners has created a great deal of market concentration. We like to describe them as the FANMAG stocks. That's the FANG stocks, Facebook, Amazon, Netflix, and Google, plus the winners from the first round of the tech bubble back in the year 2000, which are, of course, Apple and Microsoft. Those 6 companies put together had a market value at the end of last year of just under $8 trillion. Now, that's just a number. So let's put it into a context. All of China, the entire Chinese stock market, was worth 50% more than these 6 companies. Now, China has its own FANMAG stocks, Alibaba, Baidu, and Tencent, often called the BAT stocks. And those stocks comprise nearly 1/3 of the Chinese stock market. So absent those, the FANMAG stocks are worth as much as the rest of the Chinese economy put together, at least the publicly traded portion of the Chinese economy. Those 6 companies were worth more than all of the Japanese publicly traded economy. And get this, worth more than the 3 largest economies of Europe combined. UK, France, and Germany, put them all together and you've got less than these 6 companies. So a natural question, and we've heard the B word, bubble, bandied around quite a bit of late. Back in 2018, we took the time to define the term bubble in a fashion that is usable in real time and actionable. So let's take a look at what we came up with as a definition. It's a 2-part definition. If you want to use a valuation model, for instance, discounted cash flow, we've got to make implausibly optimistic assumptions in order to justify prices. So at the end of last year, just taking one example, Tesla was priced at approximately 30 times its trailing 12-month revenues. So let's suppose Tesla grows 50-fold in the next 10 years. Great. Now it's priced at less than 1 times the 10-year hence revenue stream of Tesla. Let's suppose that Tesla has a profit margin after 10 years of 10%. Why 10%? Because that matches the highest profit margin that any of the major automakers has had in any of the last 10 years. So if you take that rather extreme net of all taxes profit margin of 10% and apply it to a 50-fold growth in the company, that means that the profits would be several times as much as today's share price. But if you discount that back using just BAA yields back to today, what do you get? You get a value of $430 a share, not $600 to $700 a share. And so you have to make implausible assumptions. 50-fold growth in 10 years. What's Amazon's growth in the last 10 years been? It's grown at 26% a year. For 10 years, that works out to 11-fold growth. For Tesla to have 5 times that growth in the next 10 years would be, I think, implausible. The second part of the definition is as a check against the first, and that is that the marginal buyer doesn't care about valuation models. If they did, they wouldn't buy. Now, it also bears mention that there are anti-bubbles. Anti-bubbles are less common, and they can't apply to individual companies. Any company can go to zero. But segments of the market, sectors of the market, country allocations, groups of stocks largely can't go to zero. It's not impossible, but largely they can't. And so there, the reciprocal definition does come into play. If we're using a valuation model, we have to make implausibly pessimistic assumptions in order to not earn a respectable risk premium. Today, and the marginal seller doesn't care about valuation models. Today, I would say state-owned enterprises in China and Russia probably qualify. They have a dividend yield of about 5%. The marginal seller doesn't care about valuation models. They just don't like state ownership and the fact that the state could actually cut foreign shareholders off at the knees and leave them with worthless stock at the stroke of a pen. I get that, but a 5% yield, if these countries want continuing access to the world capital markets, they're going to have to be taking adequate care of their external shareholders. If you take that 5% yield and just grow it with inflation, which means grow it considerably slower than macroeconomic growth in these countries, then that gives you a 5% real return. That's a healthy risk premium when bond yields are negative relative to inflation. So there are anti-bubbles. And if you use our definition for bubbles, you can see that GameStop, Tesla are bubbles, that Netflix and Amazon are kind of borderline calls. It's a useful measure. What do you do about this? One thing you don't do is short a bubble. Bubbles can go much longer and much further than any skeptic could ever imagine possible. Anti-bubbles, well, they can only go to zero. So investing in anti-bubbles seems to me to be a very easy decision. Now let's look at top dogs historically and ask the question, how do they fare in the long run? If we go back to 1980, this list here, what we're looking at is the darlings of the world market in 1980, headed by IBM, ATT, Exxon, Standard Oil. Half of this list is oil companies. So this was the peak of the oil bubble. Now, how many of these companies, these world-straddling giants, were still atop the world 10 years later? 2. IBM and Exxon were still on the list. IBM fell from first place to 8th place, Exxon from 3rd place to 10th place. 10 out of 10 of these stocks underperformed the world market. 8 of them badly enough to fall clear off the list. 2 of them stayed on the list, but still underperformed. The list of 1990, now you've got 8 out of the 10 largest are Japanese companies. Half of them are banks. This was the peak of the Japan bubble. And again, how many of these 10 world-straddling colossi were still on top of the world 10 years later? Again, the answer is 2. NTT and Exxon, partly because it merged with Mobil. NTT tumbling to 7th place. Exxon rising from 10th place to 8th place. So you had 1 out of these 10 beat the world market. 1 out of 10. You had 8 out of 10 fall clear off the list. Well, was the picture any different in the year 2000? Well, yeah, it was. You wound up with the peak of the tech bubble. So half of the stocks on this list are tech and telecom companies. And how many of these were still among the world's leading companies 10 years later? Well, this time it's 3. Microsoft fell from first to third place. Walmart stayed steady in fifth place. ExxonMobil rose from eighth place to second place. Not bad. But 7 out of 10 fell off the list. 8 out of 10 underperformed the world market. You're seeing a pattern here? What about this last 10 years? 2010 wasn't the peak of any evident bubble. It's a much more diversified list in terms of both industries and geographies than any of the preceding lists. And yet, how many of these were still on the list 10 years later? 2, Microsoft and Apple. 8 out of 10 fell off the list. 8 out of 10 underperformed the world index. So you see a pattern, 8 to 10 out of 10 underperforming, 7 to 8 out of 10 underperforming badly enough to fall clear off the list, which brings us to the current list. Well, gosh, this is a remarkably tech-centric list. 9 of the 10 companies, while they might not be categorized as technology, Amazon is among retailers, 9 out of these 10 have technology as the core differentiating skill they have relative to their competition. So it's even more tech domination than we saw in the 2000 tech bubble. How many of these will still be world-straddling colossi 10 years from now? If history is a guide, it'll be 2 or 3. If history is a guide, the number 1 stock has a decent chance of still being on the list. Cool. And if history is a guide, 1 or 2 of the rest will still be on the list. Which ones? I have no clue. But do I want to own these companies? Not necessarily. If history is a guide, your cap-weighted world portfolio, your 10 largest holdings, don't do you a whole lot of good. Which leads to some work that we did on looking at the aggregate performance of top dogs in subsequent years. The blue line on this chart is the MSCI World Index. It gives you about 40 times your money after 40 years, going from 1980 to the end of 2020. 40 times your money. That's pretty good, but keep in mind that's if you never spent a dime of dividend, reinvested it all, and never had to pay a penny of tax. If you did that, you would be 40 times as wealthy, at least in notional terms. In real terms, somewhat less. What about that number 1 stock in the world? Well, that's the black line. And there have been 8 different number 1 stocks in the last 40 years. 7 of the 8 have underperformed badly enough that they're no longer number 1. Half of the 8 are no longer on the top 10 list at all. And so what we're looking at is a roster of number 1 stocks. This meltdown was a consequence of NTT, Nippon Telephone and Telegraph, going from a market cap larger than all of Germany in a single stock to a much smaller value. This one was due to Cisco and Microsoft falling apart in the aftermath of the tech bubble bursting. So you can just imagine if you owned this line, the blue line, excluding this stock, the global top dog, you own global top dog is typically 1% to 2% of the world portfolio. So you're 99% invested. You're just leaving out the 1 stock. And self-evidently, you're going to wind up with a higher return by excluding these companies. But let's go a little broader and a little deeper. If you exclude the global top 10, you're also going to help. The global top 10 that, if you'll recall, today is 9 out of 10 are tech-related stocks. That portfolio, instead of giving you 40 times your money, gives you 20 times your money. Looking at the performance, instead of 10% return, it's 8% return. You give up 2% per year compounded. That's a bunch. If you look at the number 1 stock in each country, weighted by the size of that country in the world markets, you get this green line. And that green line, instead of giving you 40 or 20 times your endpoint value, gives you 14 times your money. Now, this is on a log scale. So when you see this line going down and this line going down faster, it means you're underperforming the world market. If it's going up faster, as it was from 1997 to 2000, a steeper slope, that means that number 1 world top dog was actually beating the market. So a long-term history in which the world top dog severely underperformed by 6.5% per year compounded, did consist of a few periods of time in which the top dog won, most notably from 2013 to 20. Well, this was also a period in which value underperformed severely. So this was a growth-dominated, momentum-chasing bull market, and it continued well into 2020. But it didn't matter whether it was the number one stock or the number one stock in each country or the top 10 stocks in the world. These top dogs all reliably underperform over long periods of time. This concentration created a headwind for value.
I just want to note that for anyone interested in a deeper dive in some of Rob's analysis of what he's termed these top dogs, I would note that these exhibits come directly from a paper he wrote that's available on our website titled Buy High and Sell Low with Index Funds. Please feel free to shoot us a note if you would like us to email you a copy. With that said, Rob, what has this concentration in mega cap growth meant for value investors?
Well, clearly the companies on the top 10 list will tend to have three attributes. One, they're highly successful businesses, else they don't make it on the top 10. Two, they're big companies. Otherwise, with very few exceptions, they don't make it on the top 10. And three, they're trading at premium multiples. Otherwise, they'd tend to be well down the list. So you wind up with the top concentration of companies being high valuation multiple growth stocks. And if they're winning, that means value must be losing. And indeed, that's exactly what we find. If we go back historically, back in 1963, let's suppose your grandparents decided to buy a value portfolio and their next door neighbors decided to buy a growth portfolio. Well, what value portfolio and what growth portfolio? Here what we're doing is using the FAMA French methodology. So what we're doing is we're saying, here's the value portfolio, the 30% of the market trading at the lowest price to book values. Here's the growth portfolio, the 30% trading at the highest price to book values. Let's compare the performance of these two portfolios. Once a year, let's revisit the composition of the portfolios and make sure the growth stocks are still growth, still in the top 30, and the value stocks are still value, still in the bottom 30%. So if your grandparents bought that, which is called the FAMA French value portfolio, today, the end of this line, 4 means you'd be, if you inherited that portfolio and your next door neighbor inherited the growth portfolio, you'd be 4 times as wealthy as your next door neighbor, which is wonderful. I mean, that's 4 times as wealthy after 58 years is not too bad. But you would have been 9.5 times as wealthy if you'd just thrown in the towel in early 2007. So we had a 13.5-year drawdown in which value underperformed growth by a cumulative 58%. Now that's a whopping bear market in value relative to growth. There have been drawdowns before, the Nifty 50. Value underperformed because growth was on a tear. The oil crisis, value underperformed because oil was priced as growth stocks and they were on a tear. The biotech bubble of 1991 and into 2, the tech bubble from 98 to 2000. Each of these was a big drawdown. They were short. They tended to be 2 to 3 years long. They were up to a 40% drawdown. I had people telling me in early 2000, I don't want to talk to another value manager as long as I live. And then look what happened to value immediately after that. It went on a roll for the next 7 years, taking you from 3.5 times as wealthy as your next door neighbor to 9.5 in just 7 years. This subsequent 13 years has been just awful for value. But again, it depends how you define value. This is the FAMA French methodology, which relies on book value. Price to book value is only as good as book value is itself useful. And it's not that useful in a world in which intangibles are a larger and larger share of the value of a business. And so if you take intangibles adjusted price to book, your peak was here, 2014. You actually made a new high in 2014. If you use price earnings ratios, your high was 2013. if you use our fundamental index relative to cap weight to define growth versus value, your peak was in 2017. And likewise, if you use price to sales, your peak was in 2017. So this was the new all-time high for value investing. But no matter how you define it, that next 4 years from early 2017 to late 2020 was awful. Now, back in 2016, we wrote a paper entitled "How Can Smart Beta Go Horribly Wrong?" We were the first ever to look at the underlying relative valuation of Fama French value relative to Fama French growth. And we presented an earlier version of this graph. The blue line shows the same Fama French portfolio that we were looking at earlier. The green line shows how cheap value is on the right scale, how cheap value is relative to growth, measured in price to book value. And so roll the clock back to this peak in relative performance for value relative to growth, defined and selected by price to book value. If that was your peak in relative performance, it was not that far from a high in relative valuation. What is that relative valuation? 0.24, which means that value stocks had 24% as large a price to book value as the growth stocks. Put a different way, growth was 4 times as expensive as value. Now, a 4-to-1 ratio sounds like a big deal. It's not. 5-to-1 is the norm. So 4-to-1 means value is actually pretty fully priced. And lo and behold, it subsequently underperformed rather seriously. At the peak of the tech bubble, this 40% meltdown in performance was accompanied by a 50% drop in relative cheapness. What does that mean? It means that the book value of the value portfolio actually was growing relative to the book value of the growth portfolio. And in fact, if your portfolio is down 40% and your relative cheapness is down 50%, that means that the underlying relative price to book value is down considerably more than the performance, which means the book value is up by about 20% relative to the growth portfolio. What that means is that this wedge between the two lines got wider and wider. That wedge is the structural alpha. Notice that these two lines are joined at the hip. The green line, when it goes down, the performance goes down. When it goes up, the performance goes up. Sometimes there's divergence, as in here, 1994 to 97. But the divergence isn't huge, and it still looks sort of similar. It's just that the wedge is getting wider. Look at the more recent drawdown. The two lines, again, are joined at the hip. But from peak to trough, this is down 58%, and this is down 68%, which means that the book value of the value portfolio outperformed the book value of the growth portfolio by 30%. These lines separated one from another. The wedge widened by 30% during this drawdown. Now, I'd also note that the recovery since then has been uninspired. You see the rebound in performance here, the rebound in relative valuation here. You're still cheaper after this rebound than you were at the peak of the tech bubble, when the relative cheapness of value was 1/10 that of growth. Here it reached 1/13 that of growth and rebounded to 1/11 that of growth. That's a big rebound, but it's still in the bottom 2% of all historical experience. Which leads us to this question. What kinds of returns can we expect in various circumstances? Now, clearly, if you move to the median with value 21% as expensive as growth, you're going to have a humongous boost in performance, going from 1/11 the value of growth to 1/5 the value of growth represents an enormous gain, 7,300 basis points. And by the way, this is on a log scale, so that is equivalent to actually doubling. Now, staying right where we are, what are you going to get? Well, looking at this graph, this wedge between the two lines grows wider by about 4.5% a year. That's the structural alpha of value relative to growth. So you should reasonably expect about 4.5%. It might be 0, it might be 9% in any given year. It's not likely to be negative. If you move to the top of the cheapest decile ever, you get a 4,100 basis point gain. If you just move to the middle of the cheapest decile ever, you get 3,000 basis points. So this is why we're extremely optimistic about the prognosis for value. Now, we've also done some work on when does value add value? When does it outperform? And that work is pretty interesting. What it shows is that the narrative, the common narrative, buy value because it won't help you that much in a bull market, but it sure helps in a bear market, not entirely true. If it's a bubble bursting, value wins by a big margin, typically 25 to 35 percentage point difference in performance. But if there's a fundamental shock, I mean, this was the bursting of the Nifty 50 bubble, the bursting of the tech bubble. Big value was added. Value was down a little bit in those bear markets, but not a lot. When there's a shock to fundamentals, global financial crisis, COVID, you name it, value sometimes wins, sometimes loses. On average, it doesn't help you. This is not widely understood. Where value really shines is in the first 2 years after a bear market ends. It doesn't matter whether it was a bubble bursting or a shock to fundamentals. The rebound is very similar. First 2 years of the rebound tends to be about 2,500 basis points of incremental performance for value relative to growth. That's 1,200 basis points a year for 2 years. Put them together. Typical bear market lasts a year. First 2 years after the bear market ends gives you about a 3-year span. On average, value wins by about 30%. That's great. 1,000 basis points a year. If a bubble is bursting, and it does look like this tech bubble is showing some signs of potentially bursting now, you get 6,000 to 8,000 basis points of relative performance for value. If there's no bubble bursting, if it's a recovery from an economic shock, you still get about 1,500 basis points. So 500 basis points per annum to 2,000 basis points per annum. I'm inclined to think we're likely to see more like this because the relative valuations reached a point of the cheapest ever. Now, we've also looked at the relative performance of value relative to its cheapness. Now, here we're not using price to book because price to book, as I said, is way too simplistic and totally misses the boat on intangibles. We're using a blend of price to earnings, price to sales, price to cash flow, price to dividends plus stock buybacks, and price to book adjusted for intangibles. Using that blended metric, the average relative cheapness of value is 30%, not 20% as it was for price to book. When the relative valuation gets up around 40%, meaning growth is 2.5 times as expensive as value, value is pretty fully priced. It should be 2.5 times cheaper. But the average performance, you win more than you lose, but it's not terribly reliable. And this is looking at subsequent 5-year performance. When it gets down to a 4-to-1 ratio or cheaper, value hardly ever loses, usually not by a big margin, although in the run-up to the tech bubble peak in 2000, you did have some particularly nasty 5-year stretches, but below 25% relative valuation, that doesn't happen much. Well over 90% of the samples, you're winning over the next 5 years. When you get down below 18%, which means growth is 5.5 times as expensive as value, there's not a single time in history, not in US in green, not in international in blue, not in emerging markets in orange. There's no case where value failed to win. It doesn't mean it can't lose. It just means it never has. And the margins of victory are huge. They range from, let's say, 5% a year for the next 5 years to 20% a year for the next 5 years. What's the current level of cheapness? Emerging markets, about 15% relative valuation. US, also about 15%. International, about 20%. This is right down with the cheapest during the peak of the tech bubble. The US in green, right near the cheapest at the peak of the last year 2000 tech bubble, and emerging markets off the charts, cheaper than ever before in history. If we want to look at RAFI, keep in mind, fundamental index, takes the growth stocks and says, these stocks, thank you for the lovely gains. You're big, successful companies. You're doing wonderful things. Your outlook is great. That's already in the price, so it's not going to help me unless your growth is even faster than lofty expectations. So I'm just going to take you back down to your economic footprint, measured by how big are your sales, your profits, your book value, your dividends. Based on that composite of measures, how big is your business? I'm going to reweight you down. The value stocks, deep discounts. Fundamental index will say, yeah, I know you've got headwinds. I know you have crummy management and crummy products, but it's in the price. The market's aware of that. And you're only going to underperform the market if you do even worse than these bleak expectations. So let me top you up to your economic footprint. Tacitly, you're creating a stark and deep value tilt. Now, what we find is that RAFI, on average, is priced at nearly a 30% discount to the broad cap-weighted market. When it gets up to around a 20% discount, RAFI sometimes wins, sometimes loses. It's kind of a coin toss. When it gets below 2/3 as expensive as growth, well, guess what? RAFI essentially never fails to win, never fails to beat the cap-weighted market. For international stocks, the current relative valuation is 65%. Average value add over the next 5 years is about 4% per annum compounded. For the US, 57% of the value of the market, meaning a 43% discount. When it's that cheap, on average, you get 6% per annum for the next 5 years. And emerging markets is better than half off relative to the market. It's the deepest, almost the deepest discount ever. And at those levels, you're looking at 7.5% value add relative to the market per year for the next 5 years. Range of actual outcomes is anywhere from 1% a year to 15% a year. But boy, this is a very reassuring picture. It suggests to me that RAFI, with its deep value orientation, is highly likely to beat the market by impressive margins. In the international markets, impressive. In the US, very impressive, and in emerging markets by a remarkable margin. So that invites the question, is diversification dead? Brent, did you have anything you wanted to touch on before we move into this topic?
So Rob, a question I have, in looking at the last two exhibits you highlighted, the scatter plots with the relationship between starting valuation and subsequent return for both the value factor and then for RAFI indices, I note some similarities, but they're not identical. The value factor, there appears to be a lot of noise, and I find the line of best fit helpful in seeing the pattern. Whereas on the subsequent slide with RAFI, I don't know that I even need the line of best fit. It's a pretty tight distribution. What's your takeaway there?
My takeaway there is actually very simple. If you look at the value factor as it's defined by Fama and French, the value portfolio is the 30% that's cheapest relative to the market, but it's cap weighted. The growth portfolio, the most expensive, and it's cap weighted. Now, if you're cap weighting a value portfolio, you're not giving added credit to the companies as you go from a little cheap to very cheap to extraordinarily cheap. With RAFI, you are weighting companies relative to cap weight. And of course, this is performance relative to the cap weighted market. Relative to cap weight, a stock that's at a little bit of a discount is brought up a little bit. A stock that's at a deep discount is brought up a lot. And so you get this much tighter correlation between the relative weight of a stock and its relative cheapness. So I think you wind up with a much cleaner fit because it's a much more robust definition of what value is. There have been critics of RAFI who've said this is nothing more than a warmed over imitation of conventional value investing. Well, the simple fact is it tends to beat the value indexes relentlessly because it's not a warmed over version of value. It's a value oriented strategy that mirrors the look and composition of the macroeconomy, that puts more and more relative weight versus the market on the companies that are trading at deeper and deeper discounts.
Great, thank you. And you've spent a lot of time looking in quite detail here at the environment for value. We've seen with the extensive concentration, just a handful of growth stocks, not only has that caused some investors to question value investing, it's gotten the market concentration's gotten extensive enough for some investors to actually question diversification itself. Does diversification still work in this environment?
Both value investing and diversification work best for patient investors, and best when your starting point is that the relative valuation is pretty good, meaning that value is at or cheaper than historic norms, or diversifiers are at or cheaper than their own historic norms. We did a study in which we went back 46 years to 1975. Why to 1975? Because diversifiers like emerging market stocks and bonds, inflation-linked bonds, commodities, and so forth, many of them don't have track records that go back all that far. Once you get to 1974, you're looking at only 3 of the diversifying markets available. So we stop there. But if you look at an array of asset classes, 16 asset classes, 9 of which were available back in 1975, just equal weight the ones you have access to. 60-40, you're putting 60% in stocks, 40% in bonds, and rebalancing once a year. 60-40 gave you 10.5% return with 10.5% risk. Equal weighting 16 markets gave you 20 basis points more return, 40 basis points less risk, and a Sharpe ratio that improves by about 7%. All right, well, that's all well and good, but wait a minute, 1975, wasn't that a low point for stocks? Wasn't that a high point for bond yields? Haven't we seen bond yields tumble from near double-digit levels at the end of 74 to the 1% to 2% range today? Haven't we seen stocks roar from a Shiller PE ratio of around 8 to around 4 times that during this span? Meaning that isn't this an environment in which for 45 years, bull markets utterly dominated for both stocks and bonds? Well, yeah, that's true. So this was a golden age for 60-40. If your starting point is near double-digit yields on bonds and a Shiller PE ratio of 8 for stocks, you ought to hope you get great returns, and you did. If your starting point is 1% to 2% for bonds and a Shiller PE ratio of 32, that's another story. So the years ahead aren't going to see these kinds of returns at all. And the equal weighted 16 asset classes benefited far less from robust structural bull markets across 16 asset classes than this one did across 2 asset classes. So what do we find when we look at decades? We find in the stub period in the late 70s, you started at an 8 Shiller PE ratio, you finished at 9. 1980 was not especially robust time for stock market valuations. So your 60-40 portfolio actually lagged inflation by about 3%. It was a positive return, but it was well below inflation that was really starting to get out of hand. The diversifiers, we had 6 diversifying markets in what the category that we call diversifiers. Those 6 markets were obvious inflation hedges like TIPS, commodities, and REITs, stealth inflation fighters like emerging market stocks and bonds, and high yield bonds. Those 6 asset classes, and like I said, only 3 of these go back to 1975. Those 6 asset classes gave you a return that was above an ever rising rate of inflation. So that's interesting. Then we went into the disinflationary 80s, where inflation started to taper sharply. And stocks took off, went from 9 to 15 multiple. Bond yields tumbled. So you had nearly a 10% real return for your 60/40 portfolio, 9% for diversifiers. The 1990s, continuation of the same. Inflation continuing to dissipate. And lo and behold, the valuation multiples soared from 15 to 37. All-time high was 44, and that was in the first quarter of 2000. So you're looking at more than doubling in the value of stocks. That lofted you to an 11% real return. What did diversifiers do? They hurt you a little bit. They gave you an 8% real return. Not too bad. Coming into the 2000s, this was the lost decade. Stocks tumbled 37 down to 22, and bond yields went down and then up and then down, but net were down. So bonds did okay, stocks did not. You wound up with a skinny 2% real return for your 60/40 portfolio. And once again, 8% real for diversifiers. Well, at this point, diversifiers were no longer trading cheap relative to 60/40. They were pretty fully priced. Some of them were priced at the highest multiples or at the lowest yields ever. And so that set the stage for the 2010s, in which diversifiers struggled, partly because they were getting cheaper relative to a soaring stock and bond market. Stocks went from 22 to 33 times. Bond yields went from low to non-existent, especially relative to inflation, negative real yields. So your 60/40 portfolio gave you a hefty 8% real return, and diversifiers really hit you hard, a 1% real return. So your 16 asset class portfolio, which was a little over half invested in these and a little under half invested in these, wound up giving you a little over a 5% real return. This left people really disappointed with diversifiers. They would have been so much better off without the diversifiers, or would they? This shows the cumulative wealth differential between your 60/40 portfolio and your 16 asset class equally weighted blend. If you started at the beginning of 1975, as a 60/40 investor, you were underperforming that diversified blend by a wide margin for a long period of time. Then the tech bubble came along and lofted 60/40 past all the diversifiers, bringing you to a positive cumulative return relative to the 16 asset classes that lasted 1 month. Peak of the tech bubble. After the tech bubble started to fade, the 60/40 portfolio underperformed sharply, firstly because of the tech bubble bursting and stocks cratering, and then because diversifiers themselves started getting more and more and more expensive, sporting lofty multiples for emerging market stocks, shockingly low yields by historical standards, at least for emerging markets debt, and so forth. And that then set the stage for the 2010s, when 60/40 came roaring back. Well, notice over this entire 45-year span, we find that your 60/40 portfolio was a cumulative winner exactly once for exactly 1 month. Where we are today is a very different picture. On our website, we have return models for 130 different asset classes, and we're just highlighting a few of those here. Firstly, a mainstream portfolio invested 60% in US stocks and 40% in US bonds. Expected return. Now, this is a 10-year expected return. So this is over the next 10 years. We're expecting 2% for 60/40 investment in US stocks and bonds. We're expecting just under 2% for the return for bonds. If we're expecting 2.3% for inflation, that means a negative real return. And we're expecting just under 2% for US stocks, a negative real return. Now, you can improve that by about 1.5% by globalizing, and this is not helped by global bonds, which also sport negative real yields. But it's improved by international stocks, which are currently priced to give you about a 6%, 6 to 7% nominal return over the next 10 years. 6 or 7% sounds anemic relative to the past, but as compared with zero yields for European bonds stretching out to a decade, that's not a bad return. And in real terms, it's about 4% above inflation. Now, we look at a variety of liquid alternatives markets. You've got commodities and REITs. Over here, we have unconventional assets. Now, what are those? Those are the diversifying assets we were talking about earlier. Typical inflation hedges like REITs, commodities, and TIPS, all incidentally priced to give you rather uninspired real returns. And also things like bank loans, high yield, emerging markets, local denominated currency debt, emerging markets currencies, which is really short maturity emerging markets debt and emerging market stocks. Now, if you just held those 8 asset classes equally, you'd have the unconventional portfolio, which is same risk as 60-40, right about 10% risk, but 2.5% better than US 60-40 and 1.5% to 2% better than global 60-40. So that's a pretty good outcome. That means that unconventional assets are now cheaper than they've been relative to mainstream stocks and bonds in a goodly while. And you don't have to own all of these. TIPS with a negative real yield aren't going to deliver a positive real return. Commodities have been on a roll. REITs have recovered handily, and they're offering respectable returns, but not relative to the risk. If you chose to leave those out, bingo, you're up another 100 basis points right off the bat. Better than a 5% return at about a 10% risk. That's not a bad outcome. So the basic message here is that an unconventional portfolio, this is a beautiful time to embrace diversifiers. Now, past is not prologue. Did value work in the 2010s? No. Did value work in the 1990s? No. Did value work in the 2000s? Oh my goodness, yes. Will value work in the 2020s? If relative valuation is at all useful in predicting relative returns, they should shoot the lights out. And likewise, diversifiers are priced to do much better than mainstream stocks and bonds. So our basic conclusions are very simple. Value didn't die, it became cheaper. Value worked over the last 13 years. It got cheaper by 68%. And by getting cheaper by 68%, it underperformed by 58%. But absent the cheapening by 68%, value would have won by 2,000 to 3,000 basis points over the last 13 years. Diversification isn't dead either. It's also cheaper. And we can help all of our clients' odds of reaching their objectives with allocations based on return expectations that are grounded in today's valuation levels and with contrarian rebalancing. Brent, what other questions do we have?
Yeah, thanks very much, Rob. And again, I want to say thank you to everyone that submitted questions. It's literally the reason we do these webinars is to answer questions. So the more we get, the better. And of the 50 so odd questions we received so far, a few themes have come out. First and foremost, what I'm hearing really, or we're reading really loud and clear in terms of these questions is that more than a couple people are less than convinced that inflation may be as transitory as it's been cited. So, Rob, maybe to kick off with the questions, what are your inflation expectations?
Well, Savita Subramanian with Bank of America coined an expression about 3 months ago. She said we're headed for transitory hyperinflation. She predicted that inflation would likely peak in the high single digits, possibly even cresting above 10%, and then would settle back down, hence transitory. And she suggested that the key issue is, does it settle back down to 2% or does it settle back down to 5%? If it settles back down to 2% reasonably quickly, then inflation expectations of the general populace don't soar, and we wind up muddling our way out of this mess. If they settle in at 5, then all of a sudden inflation expectations take off, and the general public acts on an expectation of inflation, creating a rise in the velocity of money and making that rise in inflation a self-fulfilling prophecy. Now, a lot of folks shrug off the risk of inflation looking back to the global financial crisis. What happened in the global financial crisis is there was massive stimulus. The monetary stimulus, which was huge, got stuck in the balance sheet of the Federal Reserve. It never made its way out into the economy because banks were being forced to ramp up their reserves. And so the money never made its way out into the macroeconomy. Velocity of money, meanwhile, tumbled. So that mitigated all of the inflation pressures associated with the fiscal stimulus. This time around, the fiscal stimulus is, in some cases, being dropped straight into checking accounts of people who are working and don't need it, and people who aren't working and are being enabled to continue not working because of stimulus money dropped into their accounts. Okay, that means less people working to create goods and services and more demand for those goods and services. So unless the monetary stimulus stays stuck on the Fed's balance sheet and doesn't make its way into the macroeconomy, we can reasonably expect consumer and wage-based inflationary pressures. I'm a cautious pessimist on inflation. I think we're looking at decent odds of 5% inflation, give or take, over the next 2-3 years, and who knows beyond that. Given the bipartisan embrace of modern monetary theory of printing money in order to spend it, I worry a great deal that, I think they are extremely low odds scenarios, that following in the footsteps of Argentina is not impossible. This is very scary, this wholehearted embrace by Washington of MMT, just debating over the scale of the MMT.
Got it. And sticking with this inflation theme, we received questions in terms of the impact, specifically along the lines of two of the topics you covered, right? Value versus growth and diversification, or more specifically, how does inflation impact value versus growth, and how does inflation impact your outlook for U.S. versus non-U.S. asset classes?
Well, think of it this way. If you get rising inflation, you either have rising interest rates or government intervention manipulating rates to be artificially and abnormally low. If it's rising rates, then the cost of servicing the debt soars. If the rates are blocked from rising, then you become an enabler for malinvestment and an enabler for propping up zombie companies, both of which are bad. Schumpeter's creative destruction, I heard somebody rephrase it recently, creative disruption, but it really is creative destruction. Companies that have terrible management, terrible products, haven't positioned themselves for the future. It's actually good for society if they clear themselves out of the way, leaving an open runway for companies with better management, better ideas, and better products to take off. And so the creative destruction is being restrained in a very extreme way by all of these stimulus programs. So bottom line is there are some serious risks out there. So in any event, how does all of this affect value relative to growth and diversifiers relative to mainstream domestic U.S. stocks and bonds? Well, some of those diversifiers are non-U.S. Soaring inflation in the U.S. does not guarantee soaring inflation elsewhere. In fact, modern monetary theory is a luxury that can be pursued only by the country that is the world's reserve currency. Europe can't do MMT on a grand scale. We can. Emerging markets can't do MMT on any scale whatsoever. They can just do little hints of it. They can't do massive monetary stimulus without following up down Argentina's path. They can't do massive fiscal stimulus. The markets won't let them. And so if they can't and we can, then there's a competitive advantage for emerging markets that's tremendous. So we think emerging markets are actually beneficiaries of US inflation and of the US pursuit of MMT. International markets, to a lesser extent, the same thing. Now, the narrative for growth is that low interest rates and subdued inflation is great for the growth stocks and not for the value stocks. We've done historical testing. We're working on a paper that explores this in considerable detail, and we find that the empirical evidence is pretty mixed on it. There's not any strong evidence that this narrative is correct. But let's take it at face value, because if everyone believes it, it becomes at least temporarily a self-fulfilling prophecy. Well, then you'd have rising inflation and rising interest rates turn out to do damage to growth versus value. So all in all, we see this as a sweet spot for diversifiers, a sweet spot for international diversification, a particular sweet spot for emerging markets value, and a sweet spot for value versus growth all over the world.
Final question. I think this is a great one because I think it comes back and ties in both the value versus growth and the diversification, or perhaps maybe contrasting U.S. and China versus the rest of the world. This is a bit of a is this time different question. Specifically, the question is, do you make any adjustments to your strategies to account for the monopoly-like power and the resultant potential for sustained earnings growth of some of the most dominant firms?
You know, the sustained dominance of these firms is a hypothesis, not a fact. What do I mean by that? Disruptors get disrupted. Palm was briefly worth more than General Motors, and when it was spun off from the company 3Com, it was ever so briefly worth more than 3Com had been worth the day before the spinoff. So a company spins off its most valuable subsidiary, and the subsidiary is suddenly worth more than the parent company was worth before the spinoff. And just 2 years later, BlackBerry was eating Palm's lunch. And just 6 years after that, the iPhone came along and just demolished BlackBerry's market share. Disruptors get disrupted, and people forget that. So this goes back to that top 10 list of the most valuable firms in the world. Do I think some of these will still be world-straddling colossi 10 years from now? Yes. Do I care to make a guess as to which ones? Not so sure. I do think most of them will perform admirably as businesses, but will fail to live up to the hype. Cisco is worth less today than it was worth at its peak valuation in the year 2000. Does that mean Cisco's been a crummy company? No, it's, best of my recollection, its sales have grown 13% per year and its earnings have grown 12% per year for 20 years. That's tremendous growth. And so the company has grown handily, but it was priced as if it was going to grow 2 or 3 times that fast, and it didn't.
Great. Thanks, Rob. I think that's all the time we have for today. I want to quickly say thank you again to everyone who's taken the time to join us today. We very much appreciate all of the questions that were submitted. Quick reminder that our email addresses are available on your screen. Please don't hesitate to reach out if you have additional questions, if there's more information you'd like. Finally, I would like to ask everyone just take a minute or two just to fill out our quick 3-question survey. Again, we very much appreciate your feedback. Thank you all very much. Have a great day.